Hello, everybody. In this time, we are talking about marketable securities. Marketable securities are unrestricted short term financial instruments that are issued either for equity securities or for debt securities of a publicly listed company. The issuing company creates these instruments for the express purpose of raising funds to further finance business activities and expansion. Governments also issue debt securities of this type in the form of T-bills used for funding of public projects and expenditures. And then we move to characteristics of marketable securities. There are the key characteristics of marketable securities. The first characteristic: high liquidity. They can be easily bought or sold in the market without significantly affecting their price. And then the second, low risk. They are considered low risk investments due to their short term nature and the financial stability of the issuers. And third, short term maturity. Generally, these securities have maturities of less than 1 year. And then we move to types of marketable securities. Marketable securities can be divided into two types. The first type, marketable equity securities, such as preferred stock or common stock, are the equity securities of publicly traded companies that are shown on the balance sheet of the holding company or corporation. If the holding company liquidates the stock within a year of purchase, it will be treated as a current asset. However, if it is held for more than a year, it is treated as a non-current asset. If the equity of a business is bought with the aim of either acquiring a stake or controlling the business, it is considered a marketable equity security and treated as a long-term investment. And then the second, marketable debt security. Any short-term bond of a public company held by another company is considered a marketable debt security. A company holds marketable debt securities as current assets on its balance sheet. Since these are short-term investments, they are expected to be sold within a year. If held beyond this period, marketable debt securities are termed long-term investment. All marketable debt securities are recorded at cost on a company's balance sheet as current assets until they are sold, at which point any gain or loss is recognized. And then why invest in marketable securities? The reason why companies opt to allocate cash towards marketable securities is to generate a fixed, low risk return with their cash on hand, as opposed to letting the idle cash lose value from the effects of inflation. Further, companies are incentivized to keep a certain amount of cash in reserve should sudden circumstances, such as a cash shortfall, were to occur, or if an attractive acquisition opportunity appears. Compared to higher risk investments, such as options, marketable securities yield lower returns. In addition, marketable securities are usually only held for around 1 year or less. So the maturity risk is reduced from the liquidity built into the investment. Therefore, marketable securities enable companies to earn low risk returns on their cash balances while remaining prepared for a sudden need for cash. And then, how do marketable securities work? A business will tend to hold cash in its reserves. This is to prepare them for any scenario in which they need to act quickly. This could be to take advantage of an opportunity for acquisition or to make contingent payments. However, if a business merely keeps a large amount of cash on hand in its accounts, then there is no opportunity to earn interest. This means that the business will be consistently losing out on a potentially significant amount of income. To counter this, a business will invest a portion of its liquid cash into short-term liquid securities. This means that the cash isn't idly sitting and the business can actually earn returns on it. But if there is a sudden need for this cash, the business can easily liquidate the securities and have the cash on hand again. A marketable security can be defined as any unrestricted financial instrument that can be sold or bought on a public stock exchange. It can also be purchased on a public bond exchange. That means that marketable securities can be either classified as marketable equity security or marketable debt security. It is also important that marketable securities have a strong secondary market. This means that you can quickly facilitate buy and sell transactions. And if you have a secondary market, it provides a much more accurate price for investors. The potential return on these types of securities is low. This is due to the highly liquid nature of the instruments. So they are considered to be generally safe investments. And then we move to purpose of investing in marketable securities. The first purpose, held until maturity. The marketable securities of a company are held till the date of maturity. If this date is within a year, these investments fall under short-term investments. However, if the maturity date is over a year, they are classified as non-current assets held as long-term investments. And then the second, for sale. If the purpose of purchasing the security is not trading or staying invested in it fail until maturity, they are bought with the intention to sell. The marketable securities are listed at fair value without realizing profits or losses. And third, for trading. The main reason why businesses buy marketable securities is to earn short-term profits, which are typically had for less than a year. I think it is enough for this session. Thanks for watching, and don't forget give this channel with your like, comment, subscribe, and share. Thank you.